Fed Chair Jerome Powell reiterating during his press conference yesterday that it will take longer than expected to reach the 2% inflation goal.
We didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of conference. So I don't know how long it'll take. I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely.
Well, our next guest says rate cuts are still a matter of when, not if. Gabriela Santos, who is the JPMorgan Asset Management Chief Global Strategist for the Americas, joins us now. Great to see you, and thanks for joining us here in studio this morning. I mean, as we're setting up today's trading activity, of course, a lot of minds still going to be lingering on what the Fed had to say yesterday. I wonder what your initial reaction was, especially when it was largely anticipated.
I think versus the last meeting, the March meeting, certainly there was more of a hawkish tone, a realization that inflation wasn't coming down as quickly as expected. But versus how hawkish the market had gotten during the month of April, I think it was actually a bit of a relief. Ultimately, it's still the same message from the December meeting, which is we're done hiking, we're going to stay at high, not higher, for longer. And our next move is going to be a cut, and a very gradual cut. So ultimately, I think it was a relief just to hear that hikes really aren't on the table, and they had actually been priced in before the meeting yesterday.
Yeah, in many ways, this was the Fed chair trying to keep optionality open. He's kind of been doing that, at least in the press conferences here, saying that there's not going to be a rate hike, at least on the table right now, but saying that potentially, when you think about what could actually move that rate cut sooner. I mean, what is this? Is he trying to change the message here to set the expectation, at least for the market, to essentially say, look, this is where we are right now, but it's going to take some time?
Yes, and I think he really marked to market his message. The market had already adjusted quite hawkishly expectations from 7 cuts in January to barely 1 cut for the year. So I don't think he was trying to jawbone the market, really just to validate that expectation and to talk down the expectation of a hike. In terms of what it'll take, still very much on the inflation side, I think, as a priority, taking a look at actual inflation data. He seems to think 3 months is a trend. So whether we start seeing a little bit more disinflation over the next 3 inflation prints. He also mentioned inflation expectations as being very important. Consumer measures, business measures, and market measures of expectations. And then lastly, the other path he talked about is a substantial weakening in the economy and specifically the labor market. But really the focus is more on the inflation side for now, I think.
And so if we get a hotter than expected print at this week's monthly employment situation reading that we're going to get tomorrow, Friday, what does that signal for the Fed's road ahead here?
So I think Chair Powell mentioned how they see the labor market, which is one that's resilient, that's strong, but that's normalizing. And ultimately, that's what we heard from the JOLTS report earlier in the week. And what we think we'll hear tomorrow in the jobs report, meaning we're still creating, on average, 270,000 jobs a month, which is great. But you don't see that red hot jobs market that you had, which was really 2 years ago. And a way to see that is in wage growth, which we expect to increase, which has been the trend, 0.3% month over month, a little bit over 4%. And that's a labor market that's good, but not too good. So it really supports this soft landing narrative, which is our base case, as well as a high but not higher for longer message from the Fed.
Yeah, on that point, has anything changed for you in terms of your investment thesis based on what we heard yesterday?
And no, and I think that's where investors need to be really careful not to get whiplash from this narrative ping pong that seems to be the case daily. I mean, 2 days ago, we were talking about stagflation when there was clearly no sign of this at all. When you look at, for example, the misery index, a combination of unemployment rate and inflation, it's actually the lowest it's been 70% of the time since the 60s. So we got to be careful, take a look at the totality of the data. And still what it suggests is the same message from earlier this year, that this is a non-inflationary good economy, and that is quite supportive for risk assets, equities, corporate credit. It's just the valuations. It's much harder to eke out value, and that's where you have to really take an active approach.
Gabriela Santos, who is the JPMorgan Asset Management Chief Global Strategist for the Americas. Thanks so much for taking the time here with us.
Thank you.
Absolutely.